Welcome back, folks. This is ICT with a fifth installment of the 8 in the continuing series for the first month of the ICT mentorship for the month of September. The previous tutorial in session 4, we looked at equilibrium versus discount. This session, we're going to be looking at equilibrium versus premium. We went through a great deal of content in regards to discount versus equilibrium, so we won't have to spend so much time with this tutorial because everything we're selling here is basically diametrically opposed to what you would expect to see in the equilibrium versus discount teaching. So looking at what we have, when we look for premium markets that are in a premium, now when we talk about commodities later on in this mentorship, the topic of premium will come up again. But when I'm referring to premium as it relates to price action, I'm actually referring to the current range that we're trading in. And the first thing we look for is an impulse price swing, which is we have an impulse price swing here, we have another impulse price swing here, we have another impulse price swing here. These three price swings actually make up one larger price swing, which is an impulse leg or impulse swing by its own right. So when we define our ranges, okay, the use of the Fibonacci is helpful in this case because we can take the fib, draw from a high down to a price low. And I'm using this low here because it's the most lowest in contrast to this high. And price comes all the way back up to what I've taught in many years, the optimal trade entry, which is a standard 79% to 62% retracement level on the fib. Now, I didn't create that, but if it was just simply looking at that alone, 62% to 79% retracement levels, looking for buys and sells there, everywhere we loaded, it would be no work at all in terms of taking trades. But obviously, you probably learned very quickly, there's much more to it than just pulling a fib over top of price swings. We have in this larger price swing, we have a smaller price swing here, okay? And we have the high down to this low, and the market starts to retrace. Equilibrium, or half of the impulse price swing, has to be at least touched, and then once it hits that, we watch for price to reach up into this area here. Now, there's other disciplines out there, and other mentors and other teachers will say that the 50% retracement level is a good level to trade at based on price swings. I don't agree with that. I understand that sometimes it's going to work, but what I want to do is I want to be selling at a market that's at a premium level. For a market to be at a premium in this current price range here, and that's assuming none of the price action from this high down all the way to the right has not happened yet. So you'd be watching price in this initial range, and price did not get back up to the midway point, or 50% of the range that was created from the high to the low. That's all equilibrium is 50% on the fib. That's how I'm describing it. But the concept is you have to see a market price, a move above the halfway point. Once it does that, it starts going into what is referred to as a premium market. That means it's at a really high price relative to its current trading range. On this price swing here, it obviously never gets above the 50%, never even touches it. So it never gives us an opportunity to get short relative to this time frame or this price swing. So there would be nothing to do there. The next price leg here, okay, the same thing from this high to this low. Nothing in terms of that price swing there. It doesn't get back up to the 50% level. But look closer. There's another smaller price swing that has formed right in here. Okay, so we could look at that, measure the high to the low, and the market gets right to equilibrium, but does not stay above to go to a premium market. It only goes right to the Fibonacci 50 level, or what we deem as equilibrium. So price goes to an equilibrium price point and then immediately sells off. This would be a missed opportunity in regards of looking at equilibrium to premium. The reason why we want to focus primarily on the 62 or 79% retracement levels in that range to be selling short is because the market's going to be really pressed higher and would be really, in terms of overbought and oversold, it would be very overbought. And it would be expecting a willingness to sell softer and go lower. There's going to be times when the market does not give that scenario to you, and you just got to let those particular price swings go without you. The next price swing is this high to this low. Market trades back up to equilibrium here. And move this over so you can see a little bit better. Okay, so market trades back to equilibrium, goes back above it into a premium market, and it goes right on through what would be deemed as an optimal trade entry, okay, or selling at a premium. So here's a wonderful thing about this. You can look at this and say, okay, if I'm measuring this high to this low, and I want to be selling, I'm above equilibrium, I want to get short in this area between 62 and 79% tracing level, okay? You look over here, maybe there's something over here institutionally in terms of a bearish order block or something like that you can define. We're going to say that that's not there. We're going to say that we went short just purely on price action, retracing back into this Fibonacci level here. It comes all the way up and hits you where your stop would be. When you see these conditions where the market trades above equilibrium and goes through the levels of 62 and 79% trace levels, what that does is it gives you a condition that we saw in the equilibrium to discount. If it takes out a previous low when it's in discount, it's probably going to be a turtle soup buy. In this case, it's going to be a turtle soup sell. It's going to be reaching for stops above the impulse swings high. And you see that here. It goes up, runs out the stops here, and then it goes lower. Where is it going to go? Where do you take profits at? Below lows that's already established in the marketplace here and here. You can see that's exactly what the market does. You can also use, when you're defining your ranges, all price swings from high down to low. Okay, you want to anchor your Fibonacci on. The market goes down from this high all the way down to here, okay, and creates that low. As soon as we start seeing it bounce up, you need 4 candles. Remember, it's the same thing we just saw on the equilibrium to discount teaching. Once you see a swing low form, you're watching that 4th candle to show willingness to go higher. It does. But then you simply wait. Here's the equilibrium price point, this 50% level in the fib. Price goes through that, so now you're going to be watching it. You want to watch to see if price gets to 62 to 79% tracing levels. It does. And it does it while it's running out that high here. So 2 scenarios. One, you could have used this high down to this low and got a stop out in the initial 62 to 79% tracing levels where we saw earlier, but it ran right through it. If you had not anchored your fib to this high to this low, you would never see this optimal trade entry, okay, or return to a premium to go short. Price is above the equilibrium price point, and it takes out an old high. So we're running stops at an old high, and we're going back into what would be a premium market. We're above the equilibrium price point of the range high and the range low, and we take stops out. That's really, really good in terms of probabilities. And the market goes down and sweeps out a previous low. Remember, when we were looking at the equilibrium to discount, every time we were buying, we were taking profits at above an old high. Okay, so when you see that, all we're seeing is the reverse of that in the equilibrium versus premium market. So we're always looking to sell at a premium. Premium is defined by, it has to be above the equilibrium price point or 50% level of the Fibonacci, anchored on a swing of clear, discernible price action. In other words, if it looks sloppy, if it doesn't really look like a solid price swing, and obvious price swings are the ones we look at. We're not looking at anything that looks questionable. If it's a pure price swing, we measure it. And this is a high, this is a low, and we went through all potential stages of all these high to low, high to low, high to low scenarios. Really nice scenario here. Again, taking profits initially at below this low here, when it would hit that, and then you'd hold out for a potential run for some of your trade to be taken off below this low here.